Picture this. The market's taking a nosedive, 20% down, and your neighbour's 401k is probably whimpering in a corner. Meanwhile, some quiet fund you've barely heard of just clocked a double-digit gain. How on earth did they pull that off when everything else was crumbling? The secret, my friends, is that the fund is a hedge fund. It's a beast built to thrive, or at least survive, when the financial world feels like it's falling apart. Stick with me today, because we're going to crack open this often misunderstood black box and lay it all out in plain English. No fancy jargon, just the real deal. So, what exactly is a hedge fund? At its core, it's a private pool of money. Think of it like an exclusive club where wealthy individuals and institutions entrust their capital to a small, highly skilled team of managers. And these managers, they promise one thing above all else: absolute returns. Now, what does absolute returns really mean? It's simple but profoundly different. It means they aim to make you money, period. They want profit whether the markets are soaring, plummeting, or just lazily drifting sideways. Compare that to your typical mutual fund. Their big pitch is usually, hey, we'll beat the S&P 500 this year. They're playing a relative game, trying to outperform an index. If the market drops 20% and they only drop 15%, they'll pat themselves on the back. A hedge fund, if they drop 15%, they've probably failed their mission. It's a completely different game, a fundamentally different mindset, and that distinction is absolutely crucial to understanding their world. They're not just trying to ride the wave better, they're trying to create their own current. Now, before you go grabbing your checkbook, there's a catch. You can't just waltz into a hedge fund with a few $1,000s. These aren't your everyday mutual funds, open to anyone with an internet connection. In the US, for instance, the rules are pretty clear. You typically need to be an accredited investor. What does that mean? Well, generally, you're looking at $1 million net worth outside your primary residence, or an income above $200,000 for 2 straight years, or $300,000 with a spouse. Why this velvet rope? Why the exclusivity? It's not just about keeping the riffraff out, though sometimes it feels that way. Regulators figure, and perhaps rightly so, that if you've got that kind of financial cushion, you can probably handle the loss if the fund blows up. These are sophisticated, often complex investments, and they come with higher risks. The government doesn't want folks losing their life savings on something they don't fully grasp. It's a way to ensure that only those who can genuinely afford the potential downside get a seat at the table, without having to move back into mom's basement if things go south. All right, let's talk money, specifically their money. Forget the humble 0.5% expense ratio you might pay on an index fund. Hedge funds operate on a whole different planet when it comes to fees. Their favorite model is called 2 and 20. That's 2% of your money every single year, just for them showing up and managing your capital, regardless of performance. Think of it as a retainer. But then, on top of that, they take 20% of any profits they generate. That's right, 20% of the upside. Let's put that into perspective. Imagine a manager starts with $100 million of investor money. If she manages to turn that into $130 million, a tidy $30 million profit, she'd first collect $2 million, 2% of the initial $100 million. Then she'd take $6 million, 20% of the $30 million profit, as a performance fee. That's $8 million in fees, just like that. Now, if there's no profit, there's no performance fee, which means that carrot, that massive incentive for managers to perform, is absolutely huge. It aligns their interests with yours, in theory, but it also means they're playing for very, very high stakes. Another key difference, liquidity. With most hedge funds, you can't just yank your money out whenever you feel like it, like you would with a savings account or a mutual fund. There are often lock-up periods, typically a year or more, during which your capital is effectively trapped. After that, you might only be able to redeem your funds quarterly or even annually with prior notice. This illiquidity isn't just an inconvenience, it's by design. For the managers, it's a blessing. It allows them to execute long-term, complex, and sometimes very illiquid trades without the constant worry of angry investors demanding their money back next Tuesday because the market had a bad day. It gives them the freedom to ride out short-term volatility and focus on their long-term strategies, which can involve investing in less liquid assets or taking positions that take time to play out. For you, the investor, it means you need to be absolutely certain you won't need that capital for a significant period. Now let's dive into some of the cool stuff they actually do. One of the most common strategies is called long-short equity. The name itself tells you a lot. On one hand, they're long, meaning they buy stocks they believe will go up, just like you might. Think about buying Apple because you think it's undervalued or has massive growth potential. But here's the twist. They also short stocks they believe will go down. Imagine it's 2009 and you're shorting a bloated, struggling rival like, say, BlackBerry, which was once mighty but clearly losing its edge. You borrow shares of BlackBerry, sell them, hoping to buy them back later at a lower price and pocket the difference. The genius here is how these two positions work together. If the entire tech market crashes, both your Apple long and your BlackBerry short might fall. But your short position helps cushion the blow from your long position. The net result? You care far less about the overall market tide and much, much more about your stock picking skill, finding the winners and identifying the losers. It's a way to try to profit from individual company performance rather than just riding the market's ups and downs. Next up, we have global macro. These funds are the big picture thinkers, the ones who gaze at the entire world economy and try to predict its tectonic shifts. We're talking about currency movements, interest rates, commodity prices, and major political events. They're not just looking at individual companies, they're trying to catch massive economic waves. The most famous example, of course, is George Soros. Back in 1992, he famously broke the Bank of England. He bet billions against the British pound, convinced it was overvalued and that the UK couldn't maintain its peg to the European exchange rate mechanism. He was right. The pound crashed, and Soros walked away with $1 billion in a single week. Macro funds like his ride these massive economic trends. They might bet on rising oil prices, a strengthening dollar, or a collapse in bond yields in a particular country. It's a high-stakes game where understanding geopolitics, central bank policy, and global trade flows is paramount. They're not just investing in companies, they're investing in the direction of nations. This one sounds complex, but it's actually quite clever. Imagine Company A announces it's going to buy Company B for $30 a share. But right now, Company B is still trading on the stock market at, say, $28. Why the $2 difference? Because there's always a risk that the deal might fall through due to regulatory hurdles, shareholder votes, or financing issues. A merger arbitrage fund steps in and buys shares of Company B at $28. To hedge their risk, they might also short shares of Company A, the acquirer, if they believe the deal isn't perfectly priced, or simply to reduce market exposure. Their goal is to pocket that $2 spread when the deal inevitably closes. If regulators nix the deal, or it otherwise collapses, the losses can sting. But when it works, these funds are grinding out steady singles, not swinging for home runs. They're looking for low-risk, high-probability scenarios to generate consistent, albeit smaller, returns. It's about careful analysis of deal terms and regulatory landscapes. Here's where things can get really exciting and really risky. Hedge funds often employ leverage. What does that mean? They borrow money to amplify their bets, they might borrow 2, 3, even 10 times their capital. So if they have $100 million of their own, they might be investing $1 billion. A small, correct market move can then explode their profits exponentially. But here's the flip side. That same leverage can wipe them out just as quickly if the market moves against them. Add derivatives into the mix. Things like options and futures contracts, which derive their value from an underlying asset. And you have even more powerful tools for speculation or hedging. A small premium paid for an option can control a massive amount of stock. The classic cautionary tale here is long-term capital management. They posted 40% annual returns for years, a truly staggering performance, until 1998. Their highly leveraged bets went sour, and a small loss, magnified by leverage, turned into a $100 billion headache for the financial system, almost triggering a global meltdown. It's a stark reminder that these powerful tools are a double-edged sword. Hedge funds, particularly those that engage in short selling, often get a bad rap in the headlines. They're sometimes vilified as market manipulators or agents of corporate destruction. But is that really fair? While their fees are undeniably steep, studies often show a more nuanced picture. Hedge funds can actually supply crucial liquidity to markets, making it easier for others to buy and sell. They're also incredibly effective at sniffing out corporate fraud or uncovering overvalued companies, acting as a kind of market police force. By shorting overvalued assets, they can actually help blunt market bubbles before they get too out of control. Yes, those eye-watering fees eat into client returns, no doubt about it. But institutions, pension funds, university endowments, sovereign wealth funds, they still line up to invest. Why? Because the best managers deliver those coveted, uncorrelated gains. That means their returns don't necessarily move in lockstep with the broader market. When everything else is sinking, a well-managed hedge fund might still be making money, providing that crucial diversification and downside protection that traditional portfolios often lack. They're not necessarily evil, they're just playing a different, more aggressive, and often more expensive game. If all this is already making more sense than every finance textbook you've ever cracked open, do me a solid, smash that like button. It tells the algorithm to show this video to the next confused soul out there, and we can all get smarter together. So how much money are we talking about here? It's massive. Banking data provider Prekin, a leading authority on alternative assets, tracks over $4 trillion in hedge fund assets under management today. Let that sink in for a moment. $4 trillion. That's double the figure from just 2008, showcasing incredible growth even through turbulent times. This isn't just about individual billionaires or old money family dynasties anymore. Increasingly, it's about institutional money. Pension funds, which are responsible for the retirement savings of millions, university endowments that fund research and scholarships, and insurance companies, they're all parking serious cash in hedge funds. Why? Because these sophisticated investors are constantly seeking diversification, absolute returns, and strategies that can perform regardless of market conditions. They see hedge funds as a vital tool to meet their long-term financial obligations and enhance their overall portfolio performance. Let's quickly clarify some common confusions. How do hedge funds stack up against their cousins in the investment world? First, mutual funds. These are your everyday investment vehicles. They offer daily liquidity. You can buy or sell shares any business day. Their fees are generally low, often just a fraction of a percent. They typically invest in long-only stocks and bonds, meaning they bet on assets going up, and they're heavily regulated by bodies like the SEC, offering protection to retail investors. Their objective is usually relative returns, trying to beat a benchmark. Next, Private equity. This is a very different animal. Private equity funds buy entire private companies or significant stakes in them, not just publicly traded shares. They then work to improve these companies, aiming to sell them off in 5 to 7 years for a hefty profit. As you might imagine, this is incredibly illiquid. Your money is locked up for years. Their fee structure includes management fees, but also a significant carried interest, a share of the profits, usually 20%, similar to hedge funds. Their objective is long-term capital appreciation by transforming businesses. And then we have hedge funds. They deal mostly in liquid assets, like stocks, bonds, currencies, and commodities, but use a far more flexible toolkit than mutual funds. While not daily, they offer medium liquidity compared to private equity, with those lock-up periods and redemption gates. Their fee schedule, as we've discussed, is often eye-watering, the 2 and 20. Their goal? Absolute returns, often using leverage and complex strategies to achieve them. They're lightly regulated compared to mutual funds, reflecting the accredited investor requirement. So, if you were an accredited investor considering a hedge fund, what should you look for? It's not just about flashy returns. You need a serious due diligence checklist. First, track record. How have they performed over a long period, not just a good year? Second, max drawdown. What's the biggest percentage loss the fund has ever experienced from peak to trough? This tells you about their risk management during tough times. Third, Sharpe ratio. This is a measure of risk-adjusted return. It tells you how much return the fund generated for each unit of risk taken. Higher is better. Fourth, lock-up terms. Understand precisely when and how you can get your money out. Fifth, style drift. Does the fund stick to its stated strategy, or does it wander into new, unfamiliar territory when performance lags? Consistency is key. Sixth, operational risk. Are their back-office operations sound? Do they have robust systems and controls in place to prevent errors or fraud? And finally, perhaps most importantly, does the manager eat her own cooking? This is industry slang for asking, does she invest a significant portion of her personal money alongside yours? If the manager isn't willing to put her own skin in the game, that's a massive red flag. If she doesn't believe in her own fund enough to invest her personal wealth, you should probably walk away. Okay, so most of us can't get into a hedge fund directly, but can a regular investor, someone like you or me, replicate some of their tactics? Sort of. You can buy long-short exchange-traded funds, ETFs, or liquid alternative mutual funds. These products aim to mimic hedge fund strategies, like long-short equity or managed futures, but they offer daily liquidity and have much lower minimums, making them accessible to retail investors. However, there's a trade-off. Because they have to offer daily liquidity and adhere to stricter regulations, they often can't use the same level of leverage or invest in the same complex or illiquid assets as true hedge funds. This usually means lower fees, but also lower potential upside. Think of it like diet soda. It has a similar flavor profile and fewer calories, lower fees, risk, but it's rarely as satisfying or as potent as the full sugar version, the actual hedge fund. You get a taste, but not the full experience. While hedge funds are legitimate investment vehicles, the world of private, lightly regulated funds can attract bad actors. You must be vigilant. Promises of fixed, unbelievably high monthly returns, like 15% per month guaranteed, are classic Madoff vibes. If it sounds too good to be true, it absolutely is. Secret algorithms locked in a black box that no one can explain. Run. Auditors you've never heard of, or financials that aren't independently verified by a reputable firm. Huge red flags. Always verify third-party administration. Make sure there's an independent firm handling the calculations and reporting. Insist on audited financials from a well-known, respected accounting firm. Transparency, even in a somewhat opaque industry, is paramount. If a fund manager resists providing clear, understandable information about their strategy, holdings, and financials, that's your cue to exit stage left. Remember 2021? The GameStop saga? It was a wild ride, and it offers a fantastic, if painful, lesson for hedge funds. Several prominent hedge funds had taken massive short positions against GameStop, betting its stock price would plummet. But when an army of retail traders, coordinating on online forums, piled into the stock, they triggered what's known as a short squeeze. The stock price rocketed, forcing those hedge funds to buy back shares at exorbitant prices to cover their bets, leading to staggering losses. In a matter of weeks, these funds collectively lost an estimated $50 billion. The episode was a brutal reminder that even the most seasoned pros, with all their sophisticated models and leverage, can sometimes be caught on the wrong side of a trade, becoming the dumb money when crowd dynamics shift and unforeseen forces come into play. It showed that markets are not always rational, and even the biggest players can be humbled. So, after all that, what is a hedge fund? It's a lightly regulated, often high-fee partnership that leverages aggressive, flexible, and sometimes complex strategies to chase absolute returns, aiming to make money even when traditional markets tumble. They're exclusive, often opaque, and can be spectacularly profitable or catastrophic. You don't need to love them, and you certainly don't need to invest in them, but understanding how they operate makes you a far smarter, more informed investor in any market weather. Knowing their playbook helps you understand the broader financial landscape. If you got value today, subscribe and drop a comment below with the strategy you'd try first if you had unlimited capital. See you in the next video.